Hi there, eToro. It is Monday the 28th of June, and that means it is time for my weekly review. So let's take a look at what moved the markets last week. Starting as we usually do, we can see that the 12-month returns for the S&P 500 from the end of June to nowish is about 40%. I've kind of eyeballed this, by the way, so it's roughly right, whereas my portfolio has given a return of 58%. The market has been very good for the S&P 500 and the NASDAQ. The S&P 500 is sitting at all-time highs. And as you can see from the heat map of the stocks, just about everything is green with a few little red spots here and there, each one representing a particular stock. Nike is one of the standout performers of the week, and I will talk about that in a moment. I couldn't find a heat map for the NASDAQ that is as good, but you can also see that for the large part, the week was pretty good for most sectors and stocks. Okay, some of you might remember that last week in my weekly review, I spoke about the Fed and the news that they announced on Wednesday of the week before that, saying that they were going to increase rates faster than they had initially thought, and also acknowledged that inflation had risen by more than they had thought. And there was a knee-jerk reaction by the markets, so everything sunk. And there was some volatility for a few days after that, after the market was trying to choose a direction. But I had anticipated that eventually the market would be quite happy with the news, because they would feel that with the Fed acknowledging the inflation, as well as bringing a plan into play to deal with that inflation, that would give us a firm footing to take another leg up. And that seems to be what has happened in the past week. And that's my expectation for the coming quarters too. The market really doesn't like uncertainty. And although the hawkish news from the Fed affected the market negatively initially, at least it gives the market something to work against. It gives them a target, it gives them a plan. And I think they believe this plan a little bit more than the plan that the Fed was putting out there previously. I also wanted to talk about the UK stock market performance. So the UK 100 has actually done okay through the past week. I think it notched up maybe a 1.7 or 1.2% gain. But you will see that in our portfolio, at least, the travel stocks within the UK are some of the worst performers on the week. And for those of you living in the UK, you know that this is almost certainly because our lockdown was extended. So now we will only be completely opening up in July, 19th of July. And our government has said that this is definitely going to happen, no more delays. But I think we'll need to see what happens, right? It depends on the data and the situation when we get closer to that particular date. I'm optimistic, and I think the government is optimistic. Our case numbers are rising, but our hospitalizations so far are actually not too bad. So for now, these stocks have been hurt, but I expect that it's a short-term effect that we will see on these stocks because our vaccination levels are very high and the vaccines are effective. However, the Delta variant is now making its way around the world. And a few weeks ago, there were various people saying that the Delta variant would become the dominant variant globally, which I guess is fairly obvious given that it seems to be more infectious and spread quite quickly. So within the US, this is becoming a very, I hate to use the term, but a common strain within the US, and the story in the EU is similar. I expect that this is going to play out around the world. The challenge is that very few countries have had the degree of vaccine rollout that the UK has had. And so those countries are more exposed, particularly the developing nations, the poorer countries. So I am quite worried about how this is going to affect people on the ground, but there is also a chance that this could completely throw off the global recovery as the world enters further lockdowns or continues to extend their lockdowns. This is something to watch. It could be dangerous in every sense of the word. All right, onto some good news. So I don't invest in Nike, or Nike, depending on your pronunciation, but they had an incredible fourth quarter. So they announced their earnings last week, and the stock price jumped massively. And not only did Nike's stock price jump, but a lot of retailers, particularly the sporting retailers, their stock prices have also jumped quite a lot. So Nike did quite well and also has increased their forecast for the year. What I found quite interesting, you don't see this very often, is that Nike also, I'm going to zoom in a little bit. So Nike they also have an outlook through financial year 2025, which I quite like. This is a company that's willing to commit. They have a plan, they've got a strategy, and they're willing to commit to their numbers. Now, maybe they don't hit the plan, right? Maybe something happens, and that means that some of these targets are hit and others are missed. But it's nice to see a company forecasting and standing by their forecasts. So this ambition is really, really good. And given Nike's performance recently, there's no reason where they might not hit the majority of these targets. So just a little bit of interesting information. Now, in terms of our portfolio, the reason I find this an interesting data point is that I hold a number of retailers. They're not all clothing retailers. ASOS, though, is one. And so this seems to bode well for online retailers. Maybe Nike is a standout example, and for some reason they did better than everyone else, and everyone else is going to do poorly, but I don't think that is going to be the case. ASOS, I'm very interested in, and I've been tempted to increase my position recently because the stock price has drifted lower and lower over the past few weeks and months. And ASOS is a UK company, but they've been expanding globally, and the expansion into the US has been very good. They've seen good growth in their numbers. I also think that the analysts and markets have misunderstood ASOS. They think that the company would only perform well during lockdown because people were stuck at home and they were shopping more. Now, with the world opening up, they think that ASOS is not going to do as well as they have done recently. Now, I think that there are two broad themes that the market is missing. First of all, the world is still in the process of opening up. And as the world opens up, people need different kinds of clothes to the clothes they've been wearing at home. So everyone's been in their PJs or, they're comfortable house clothes. And now they need to buy new clothes because they haven't worn suits for years. Maybe they've put on a few kilograms during the lockdown, or maybe they just need some new clothes, professional clothes, going out clothes, etc. So I suspect, and the CEO has hinted at this, that we're going to see a boom in certain types of clothing purchases from ASOS. And even more interesting than this is that these types of clothing items for ASOS are higher margin. So the clothes that you wear at home are cheap clothes, let's say your PJs, your pajamas, they're cheap clothes to buy, and the margins on those clothes are actually quite low for the likes of ASOS, whereas your suit that you wear to work and your nice leather shoes and your girlfriend's going out cocktail dress are the higher margin items, the more profitable items. So I've been invested in ASOS thinking that the market has gotten this a little bit wrong, and I'm wondering what Nike might be signaling for us and ASOS in particular in the future. And we'll find out. They report earnings next month. Another very interesting piece of information that came out last week. It affected First Solar and other solar stocks in our portfolio. I did make a video about this already, and that piece of news is that the US is banning imports of solar panels from the majority of Chinese companies that the country imports from. In addition to this, the US is mulling over the potential for tax credits for those companies, US companies that are involved in the solar supply chain. So I alluded to this particular question in my video. So with this ban, will America be able to source enough of the solar panels, the number that it needs? Now, what's quite interesting and seemingly coincidental, but I don't think it is that First Solar, I think it was 2 weeks, maybe 3 weeks ago, they announced that they were putting $680 million towards a panel factory in the US. This is great news for First Solar, and I suspect that the US had spoken to First Solar about this prior to the news that we saw out of the government last week. So I'm still not sure whether First Solar, it's going to take time to build this factory, and even then, I don't know that that will be sufficient capacity to meet the demands of the US market. So it'll be interesting to see how the US deals with this. They're going to have to source their materials from other countries as well as building it domestically. But overall, this is good news for the solar industry outside of China, I guess. All right. I also wanted to talk very quickly about, so here we have the 1 week gains, we have the losers, and I showed you some of the losers in the portfolio, and we have some of the winners. First Solar is in there for the reason that I mentioned previously, but also First Solar is just a fantastic company. But we can also see a number of Chinese names in this list. So I mention this just about every week, but Chinese tech did very well through last year, through to the middle of the first quarter. Chinese tech, this is an ETF that represents Chinese tech, more or less. Chinese tech then dumped for a number of months, tried to recover, put in new lows, and seems to be climbing out of the bear market that it had found itself in. So it dropped from $108, this ETF, all the way to 80. So this is a 20% drop, and then further to 75. So definitely a bearish market. And then there's some frothiness always as the market slowly regains sentiment after the bearish drop. It looks as though these stocks are now climbing out of that bear market, and that sentiment is starting to turn, which is fantastic because there are lots of excellent companies whose share prices have dropped off and they're very, very cheap and shouldn't be. So this is the reason that we have seen some of these stock prices appreciate, and I don't think it's the end of this particular trend, especially as we go into the second half of the year, which is good for retail. And quite a few of these companies are involved in the retail game. Let's take a look at commodities now. So I have been using commodities as an early warning signal for inflation. And it worked pretty well through the first 6 months of this year. And now we have seen some commodities really give back a lot of those gains. So lumber, you can't see it now, but at one point I think it was up 150%. It doesn't matter. Lumber was up massively over the past 12 months. But as you can see from here, over the past month and a half, 2 months, the price of lumber futures has dropped from 1686 all the way to 775. So it's lost more than half of its value. At these heights, it was really impacting the market. So house builders who need lumber in the US had started saying, we can't build houses at this cost point because we are no longer profitable. So a lot of them were saying, we're just going to stop. We're going to wait for the prices to come down. And we're seeing the unwinding of this incredible bull run in lumber. And the reason we're seeing this massive drop off is a few reasons. So demand dropped off around about this height. But also a number of companies would have been stockpiling, buying more than they needed on the way up. Just like people bought toilet paper when the lockdown first happened. Companies were overbuying their supplies on the way up, anticipating higher and higher prices. So they had built up inventories beyond what they needed. And then on top of all of this, we would have had speculators, people that were looking to make money off of the rising prices. So they got involved and they were buying, driving the prices up. So all of those things contributed to demand, driving the price up. As the price started falling, we saw that demand drastically decrease. So potentially it was the house builders that stopped buying, and then we saw the speculators getting worried and jumping out of their trades. Then we saw the people that had loaded up on lumber supply trying to potentially get rid of their oversupplies, anticipating having too much of a very expensive lumber inventory, thereby driving the price further and further south, as we have seen here. The same story hasn't played out as strongly across other commodities. I had thought that we might see something like that in copper, temporarily though, because I think that long-term demand for copper is only going to go up. And so we've seen a little bit of a loss in price for some of these commodities, but a fairly strong rebound in the past week. So it's not very easy to determine exactly what inflation might do from the picture that we're seeing here, but this continues to be an area that I watch. I don't like using the term FUD very often. I think it is massively overused, but in this case, it really, really does apply. So we're seeing headlines like this today with regards to cryptos in the UK. And although I guess in the broadest sense, this headline might be correct, the key message that it conveys, the key understanding that people might have reading this headline is not correct. So it is not the situation that people in the UK will not be able to trade cryptos on Binance. Instead, the UK the FCA has been looking into Binance Markets, which is a part of Binance, the company, but doesn't offer any products or services on the Binance.com website. It hasn't even launched a business in the UK yet. Instead, the FCA has looked at this particular business and has said, we do not want companies that aren't authorized to sell derivatives of cryptos within the UK market. Long story short, the FCA is not saying you can't sell cryptos. That is not a law or a regulation in the UK at the moment. Binance will continue to be able to sell cryptos. The media is tricky like this. They know that the more dramatic the headline, the more people are going to click on the article. But if you read through the details of the article, you can very quickly recognize that this issue is nowhere nearly as large as the headline suggests. The crypto market, I think, might have realized this because this has not created a dent in the price action recently. And in fact, cryptos such as Bitcoin have been rising through the past day or so. I also wanted to look at the ARK Innovation ETF this week. So I've said before that ARK is having an outsized effect on the market. It is driving the price of growth stocks, even if those growth stocks aren't a part of its ETFs, for a number of different reasons. And so this kind of becomes a signal for the growth sector. As we know, this ETF saw massive inflows through last year and the beginning of this year, and the price appreciated massively to nearly 160, and then it lost a lot of its value all the way down to around about the $100 mark. And lots of the pundits and haters were talking about Kathy and her terrible ETF and how it was the beginning of the end and she didn't know what she was doing, etc., etc. However, what we've seen since then is a 25% appreciation in the ETF. And to me, this is a good ETF to watch in order to determine the sentiment within, let's call them aggressive growth stocks. So those stocks that are a bit more speculative than big tech companies, maybe they have little or no profits, maybe they don't even have revenue. And so sentiment has definitely shifted with regards to this type of business. And I think that the reflation trade was overdone, and now we're seeing some money pivot from that trade back into growth. This is great because it means that instead of all of the money being focused in just a few sectors and creating bubbles, it's now spreading out around the various sectors within the stock market. Will the ARK Innovation Fund retest its $160 price point? I don't know. I'm not sure that's going to happen very soon. Maybe we'll see some kind of a melt up and it would happen, but I expect that people will continue to be a little bit more cautious after having seen the massive drawdown for those that participated in this ETF earlier this year. All right, lastly, I wanted to talk about what's coming this week. So Micron Technology, they will be reporting earnings on Wednesday evening. As many of you know, they're one of my favorite companies at the moment. Don't just look at Seeking Alpha, but what you will notice is that the market is mostly bullish on Micron, although there are some bearish theses out there. You should always listen to both. It doesn't mean you should read up and understand the various theses. It doesn't necessarily mean that you should believe them. I'm not sure which way this earnings call this earnings report will go for Micron. I hope that it's very good and we see some price appreciation, but even if it isn't, I believe that for the next few quarters, the company is only going to knock it out of the park. They are a very strong business. They have been growing very well in recent years. They're not a young company, by the way. They've been around for a long time. Their business is cyclical, and I think that they are entering a part of the best part of the cycle for them, especially with the chip shortage and with the growing number of businesses that are online. Just about all of our lives are moving online now. So I think that we will see their their margins boosted through the next few quarters and years, increase in profitability, and we should see some decent growth in profit. And stock prices are a function of profitability in the long term. So I think that we will see some decent price rises there. And the very last thing for today is the 30th of June is the end of this month, but it's also the end of the quarter. And quite often what we see is the larger financial players and professional investors, the funds, they will be rebalancing their funds, taking profits from those positions that have made them a lot of money and moving that money into other areas of their portfolio or new positions that they think will be profitable. So we might see some volatility. Sometimes that happens, sometimes it doesn't. But we will almost certainly see a lot more volume. So keep an eye out for that. All right, that's it for this week. Thanks for watching the video, and I'll see you next week. Goodbye.